Show education series with Patrick Ceresna from Big Picture Trading and my favorite podcast, Macrovoices. This is part 2 of a 4-part series. In part number 1, we discussed options and how that's a great way to play gold, silver, and the miners to maximize your upside but limit your downside. Today, we're going to be discussing the basics of options and really understanding them well. Even I want to get up to speed on this one, but I need your feedback. I've been going back and forth with Patrick, and he's maybe considering doing a live session at the end of this series where you guys could log in and watch Patrick do his thing, buy and sell in the live market. So if that's something that you are interested in, make sure you email Sebastian and let him know. Editor, go ahead and throw up Sebastian's email right now. And guys, I cannot wait to dive right into this content and help you understand options a lot better.
George, thank you for having me back, and looking forward to taking all of your listeners through this 4-part series.
Awesome. So let's dive right in. I'm kind of a novice to this, so I'll just go ahead and interject questions whenever I have them. Other than that, you can just walk us right through it.
Absolutely. So what we're going to cover here, so in part 2, we wanted to really focus on an introduction to options. So last session, we kind of went in and talked about, well, let's show you how tactically you can use options to build asymmetry. But we never really spent any time getting into the details of the mechanics of how an option actually works. And what you find is a lot of people are very much intimidated by this, because the truth is that there is risk in not understanding something. And if you're going to open a new opportunity, you need to understand what you're opening and what you're doing with the trade. And so what we want to do through this series, first we're going to go through how options actually work. And then in part 3, we're going to go through the myths and misconceptions about options and really tackle all of those stereotypes that we hear about options. And we'll take them head on and actually look at the actual truth of how options work and where are the pitfalls and where are the advantages and what is the trade-off in using options as a strategic tool. With that said, let's just dive right into it. So in this introduction, we want to just get right to the most basic element of understanding what an option contract is. Now, if you recall, in the first session, we talked this idea about us transacting a car. Right? We talked about this idea of, well, I'm going to enter a contract with you to buy that car in the future, and you put you pay a certain amount of money for the right to be able to buy that car in the future. Let's actually look at a real example. Let's go through some examples that I actually priced out today. So this is relatively fresh data that gives us an idea of what these options contracts are and how they work. So first of all, the most important thing, like in that example, is that it's a contract between two counterparties, a buyer and a seller. It's so important to understand that you can't have an options contract come into existence without the two counterparties. And the buyer of the option, which is paying a premium, has purchased the right. And it's a right that they can choose to exercise anytime they want. Majority of options are a term that we call American style options, which is essentially, even if I bought 1 month of time on a call, I actually can pick up the phone tomorrow, call the broker and say, I want to exercise my right to buy. You can actually have a fundamental right that is yours, and this is what guarantees the option to have a value, is that right that you're buying. Now, the counterparty who receives the premium, and remember, retail investors can be sellers of options just as easily as they can be buyers. And so because of this, if you feel that the advantage is to the seller, you can turn around and become a seller of options. But a seller undertakes an obligation, the obligation to be the counterparty to the buyer who actually has the right. And so let's explain through examples. It's a lot of terminology, and the best way to actually learn a lot of this is actually getting into a real practical example. And so in this example, we have two types of options: call options and put options. We're going to explain each one separately here in a moment. The two characteristics you want to always remember is that there's a specific period of time on an option and a specific price it can be transacted at. And each contract controls 100 shares for the majority of securities. Now, if you get into the options on futures contracts and other things like that, there's other multipliers. But what you want to think is that when we're dealing with options on stock, you have to think most of it as 100 share increments. And so either I'm going to buy one call to control 100 shares, 3 calls to control 300 shares, and so on.
Okay.
So let's go on and talk specifically about these call options. And so in this situation, the call buyer of an option is securing the right to be able to buy the underlying security at a specific price over a specific period of time. So if you remember in part 1, we used those long-term call options on the GDX, and we were the buyers of these call options. What we were securing at that $29 price in that example was my right to buy at $29, a specific price, and we bought that option for 1 year, which gave us a specific period of time from which we can exercise our right to buy at 29. The counterparty it's a very simple. It's a zero-sum game between these two particular counterparties, because the seller of the premium receives an income, but for the obligation to have to sell those shares to the buyer on demand, basically at that specific price over that specific period of time. So if our first investor, the call buyer, was ready to buy those physical shares, the seller has the obligation to deliver them. Mm-hmm. So why would the seller do this? And this is where we're going to kind of look at the example of the two counterparties. So here we're going to use the GLD itself, the gold ETF. So we're talking bullion, an ETF that represents the gold bullion with the GLD symbol. And it has a very robust options chain on it. So you're able to do these strategies. And so in this example, we have our investor Jane, who doesn't own the GLD shares yet, and is looking for a tactical way to participate on the upside of gold with some form of an option. So she's looking to buy a call. Our counterparty in this case is John, who actually physically owns the shares of the GLD. And in the options market, you could theoretically be naked, but for the sake of this example, where John actually owns GLD shares, he actually has the gold. But now what makes a market is different opinions. And John has a very different opinion than Jane. Jane thinks gold is going higher and wants to participate. But John, on the other hand, believes there's only a limited upside on the short term for gold and is looking to enhance his returns through selling some options for income. And so they make two very good counterparties for each other. So at the time when we're doing this example, GLD was trading close to $150 a share on March 3rd, right? So that's today when we're recording, and it was the GLD earlier before the 50 basis point rate cut was actually trading close to 150, but obviously popped a little bit since then. So we have two counterparties that meet through the options exchange and enter a contract, one being the buyer and one being the seller, right? And so in this scenario, our two counterparties, Jane and John, enter an agreement at the $150 strike price. So the GLD could be at any price. It could drop down, it can jump to 154, it could jump to 146, but the two of them have entered a contract where Jane has the right to buy those shares at $150. Mm-hmm. Now, they agree upon a 6-week time frame. So they're agreeing on an April 17th options expiration. So not only does Jane have the right to buy the GLD at 150, she has 6 weeks to decide if she wants to buy it at 150. And she actually has the right, as an American-style option, at any point to call in or exercise her right to buy those shares. Now, in an option, what happens in the speculative world of options, a lot of traders will buy a call and later sell the call for a profit, never taking the ownership of the stock. They just use the option as a speculative tool for market timing, and they're actually using it as a way of leveraging their returns. But the reason that option had a value was the inherent fundamental right to be able to buy it at 150. The reason that option went from, let's say, $3 to $6 or $9 is this contractual right. And so when I teach it, I like to really go back to what is my actual right. In this case, Jane has the right to buy those shares over the next 6 weeks at $150. They agree upon a $4 price per share. So in this situation, literally Jane pays, remember it's 100 shares per one call option. So Jane pays $4 times 100 shares, $400 to John, who receives it as income.
Mm-hmm.
Now, John immediately receives that cash. In the options world, that's received as a credit. You could theoretically, in your options account, go ahead and spend that right away. You can. That's actually guaranteed money, as real as a dividend. But John has an obligation for 6 weeks, doesn't he? That's not, that $400 wasn't for free. In the end, John has to, for 6 weeks, be prepared to deliver the shares to Jane.
So he wouldn't be able to sell his shares for 6 weeks, or until Jane.
If he was to be covered, there are people that are willing to hold their positions naked and things like that. But for the sake of this example, assuming that he wants to be covered on his obligation, he is obligated to hold the shares to find out whether Jane wants it. This is called covered call writing, and so what happens is that to him, $4 on a $150 position in 6 weeks is a great percentage return. If you're compounding that over the course of a year, you're making a very healthy return on your investment without actually needing it to rally to make money. But that's a whole different video that we can do. Right now, I just want to really make everyone understand that there's this contract between the two counterparties. And so in this situation, for the next 6 weeks, Jane has the right with the call op to call in those GLD shares at $150. Now, John has that obligation to have to deliver those 100 shares, irrespective of whether Jane exercises or does not exercise. John got to keep the $4 per share. Right. That's a guaranteed income. That was a premium paid to him for undertaking that. And irrespective of whether the GLD goes down and Jane walks away from the contract, never exercising, or whether GLD goes up and is forced to sell the shares, the $400 is guaranteed income to him. And there's an entire school of investors that feel that there's consistency in premium harvesting through the systematic writing of options this way. And to be honest, your listeners are going to have two different schools of thought. One is going to say, oh my God, Jane's got the best deal ever. And the other investor, one of your listeners, is going to be, no, you know what? If I was making $4 a share every 6 weeks off of writing options on gold, I'm going to be making all of this income. And that's what makes a market. One person prefers the bird in hand versus two in the bush. And the other says, oh, I'd rather actually take the risk of making really big money. And so that's what makes a market. And so they've entered this contract between each other. So we're going to get into more specifics on that. But now I want to go to the second type of an option. And the second type of an option is called a put option. And a put option, mathematically, when you go to algebra that actually used to compute the theoretical value of an option, is actually fundamentally the same math, but one major fundamental difference. A put option, when someone buys a put, it's the right to sell the security at a specific price over a specific time instead of the right to buy. And because there are two types of transaction, buying and selling, the call option and the put option fundamentally move in opposite directions, because one is the right to sell, the other is the right to buy. And so often people will buy put options as insurance, right? So if I own shares of GLD, actually, let's see, we're going to look at an example of it. We'll actually use an example of using it as a way of securing a guaranteed sale price. And so right now, when we are the buyer of a put, you are entering a contract that is locking in you a guaranteed sale price on a stock over a specific period of time at a specific price. Therefore, the counterparty to this is the put option seller. They, as the counterparty, therefore take on an obligation to have to buy the shares if the put buyer wants to sell it to them at that specific price over that specific period of time. So notice the difference. One has the right and the other has an obligation. That's the same for calls and puts. The sell and it's a very straightforward relationship in this manner. So going back to GLD here, $150 a share. It's March 3rd on the example. So now John here owns the actual GLD shares. So physically is owning the shares and is concerned over the short term about the downside risk associated with gold and thinks that there's room for gold to have a pullback. So in this scenario, John does not want to sell his long-term holdings just to be a short-term market timer. He's long-term bullish gold. He wants to never lose his gold shares. He's just on the very short-term concerned that there's going to be a pullback and wants to buy some insurance to kind of help buffer any short-term volatility. And so he's looking to lock in a sale price. Now, alternatively, we have Jane. Now, Jane is looking to actually accumulate or buy GLD shares. To her, she believes that gold is right now, or this GLD is at a fair price, but would love to accumulate some of these shares at a little bit of a lower price. At the same time, while waiting for the GLD to pull back, she's looking at making some income on it along the way. And so Jane and John, again, are very good counterparties for each other to enter this contract. So again, we have John wanting to buy this put as insurance for GLD stock that he already owns. And Jane is willing to be the put seller because she's actually looking at accumulating the stock on a pullback. And so in this scenario, they agree upon a $145 strike price. Now, remember, what price was GLD trading at?
At 150.
150, right. So they're agreeing for a put option at a strike of 145, which is basically, it's like a stop loss. John is securing a guaranteed $145 sale price if the GLD starts crashing. At the same time, because Jane is saying, I'm willing to buy the GLD, and I'm willing to definitely buy it $5 cheaper than where it's trading, it's a no-brainer for me to turn around and sell this put and collect some income because I wanted to buy it on a pullback anyway.
Right.
And so what happens is that this option, going again 6 weeks out, this is what we call an out-of-the-money option because the strike price and the stock price are different. In this situation, it was $1 a share. And so they agree, obviously, on 100 shares. And so John pays $100 for the insurance, and Jane receives the $100 as income. This relationship, actually, I love to use the example of car insurance. So in theory, you actually are buying a put option on your car when you buy car insurance. George, do you like buying car insurance? Paying for it? No.
No, I hate
it sucks. It sucks, right? But if you crashed your car, how glad are you that you had it?
Right.
Right? It's the same scenario. What happens is John is paying $100 for an insurance policy with a $5 deductible that is basically saying, I'm removing over the next 6 weeks all of the downside risk of loss. Mm-hmm. At the same time, I'm paying $100. And if it never goes down, well, that's good because I own the shares and it never went down. So I didn't have to actually cash in the insurance policy, right? You're not like when you buy car insurance, you're not actually hoping that you crash your car. Yeah. You just have it just in case it does.
Yeah, but Jane wants the car at 145, even if it's wrecked.
Even if it's wrecked, right? Because it's a better price than buying it in the open market at 150. Right? Yep. And so it's not a total write-off, it's gold, right? It's just as good. We're talking about hedging a short-term risk. So what's happened between the two is that for the next 6 weeks, John has secured a guaranteed sale price, his right, that is his choice. He could pick up the phone at any time and call the broker and say, I'm exercising my right to be able to sell those shares at 145. So if let's say the opposite happened today and the Fed didn't cut and there was some sort of very kind of hawkish news that came out and gold just slams $100 to the downside and the GLD is ripping $10 to the downside, in the end, John has secured himself a guaranteed $145 sale price irrespective of where the GLD is trading. Yeah. At the same time, Jane undertook that obligation but made the income. And there's a whole, no different than the insurance company that you bought your car insurance from is looking to make income from you not crashing your car. Jane is making an income for offering that bid of saying, well, listen, you could always sell it to me at 145, and in the interim, I'm going to just keep making this income. And I'm going to be waiting to see if I can get to buy my gold at a cheaper price.
Mm-hmm. Yeah. Yeah.
Right? And that's what makes a market. And again, it's not, I don't want your listeners to in any way walk away with this saying that like John, number one, that's buying is better than counterparty two, Jane. What I love about the market is that in the whole process, there are amazing strategies that Jane can make consistent income on, and there's amazing uses for the options as protection for John. And what makes a market is the fact that we can tactically use these options in combination with stocks that we own and other things to use them to manage risk, to leverage upside, do all sorts of these amazing things.
Yeah, it's really incredible. I just I knew that how this worked to a certain degree, but I'd never really thought through of how great it is and how you can utilize it to make things just more, in my mind, more consistent and more reliable as far as the returns. Now, let me ask you a quick question. Can you just do this with any typical brokerage account, or do you need to have something special?
Most brokerages provide options, but you need to be approved for them. And so you so you have to go through the extra process of having the brokerage account approve your account for options. And the standard thing of selling a call against your stock, buying a call or buying a put as insurance, those are actually the most fundamentally basic transactions that actually get auto approved. It's when you want to get into spread trading and nakeds and all these different things that they require additional approvals, because you can put yourself in more harm's way with some of the riskier strategies, which if you're not well educated on what you're doing and how to manage them. And so, but to get the basic options approval is available at almost every brokerage, and you can just get your account approved for that, including in let's say 401ks or in Canadians RSPs, or you can do these in actually retirement accounts for most people as well. So what I wanted to leave all of your listeners with is just really touching on this idea of how this options contract exchanges. Now, in this example, our two counterparties, Jane and John, where I was giving this illustration that they met and shook hands and they agreed upon that. Now, anybody can actually create an options contract, what's called an over-the-counter options contract, which is essentially introduces counterparty risk, default risk, or credit risk, all sorts of different things, because if Jane doesn't want to honor it to John, John's got to take Jane to court and back and forth, right? There's all sorts of risks of the two counterparties against each other. What is amazing is that this all became exchange traded. And so for the options existed forever, but what's happened is that when the options exchanges listed options and created clearing corporations, what they did is made these options fungible, which is that they standardized the strike prices, the expirations, and they made them interchangeable. So when John and Jane make a deal through the exchange, later on, John can sell it to Peter, and it's interchanged. They don't have to, John doesn't have to go back to Jane to close the options contract. They're all interchangeable. And so when we buy and sell options in the options market, we don't actually have to know who the counterparty is. And one of the reasons that is because not only is it standardized and fungible, but the clearing corporations remove all counterparty risk.
Right.
So they actually guarantee that you will settle what your options contract is guaranteeing you.
Right.
And therefore, what happens, the clearing corporations ensure that their clients have, on the other side, have sufficient margins, sufficient securities, all of that. It's not your problem. This allows us as traders and investors to go and click a buy on a call option on our brokerage screen and not have to know who we sold it to. right? It's all interchangeable. And the fact that market makers are making this active market and always providing a bid and ask, we always have a liquid market to trade in, but never fundamentally lose sight of what our rights and obligations are, and the fact that there are two counterparties that are actually trading against each other.
Yeah, it totally makes sense.